Hello everyone, welcome to lecture 3 of module 5. In this lecture, we are going to discuss about the various problems related to DuPont model. As you have already attended the theoretical part of the same in the last lecture, where you come to know that while calculating the DuPont model, we will be following 3 steps, so that we will be able to predict the ROE, and on the basis of that the investors can take their decisions. To start with the lecture, we will be having the first problem in which we will simply imply the formula and calculate the ROE. So, we are having following question. From the following information, you are required to calculate ROE using the DuPont model, in which the question we are provided with the information like net income 5 lakh rupees, revenue 50 lakhs, total assets 40 lakhs and the shareholders equity 10 lakhs. In this question, you are provided with all information without any further calculations. So, we will just put it into the formula for the computation of ROE. To start with, as we know, the ROE is having the 3 components. The one is net profit margin, into asset turnover multiplied by equity multiplier. So, taking one by one, first we go with the computation of net profit margin, which is equal to, the formula we will use here is the net income upon sales as provided into the question. The net income is 5 lakhs and the revenue generated from sales is 50 lakhs. So, we go with net income 5 lakh divided by the total sales or the revenue available in the question is 50 lakhs. We got a figure of 0.1. Now, going for the next calculation, that is regards to asset turnover, which is equal to sales divided by total assets. As we know, the total revenue provided in the question is there 50 lakh rupees. So, we compare it with the total assets which are given 40 lakh rupees. So, our asset turnover will comes to 1.25. Now, going to the next step, the third component we have to compute is equity multiplier. Equity multiplier, the formula of the same is the total assets upon shareholders equity as given in the question. The total assets amounting to rupees 40 lakhs and shareholders equity is 10 lakhs. So, we put the figures 40 lakhs divided by 10 lakh, it comes to 4. So, as we have already computed all the 3 components, one is 0.1, another is 1.25 and the third component is equal to 4. So, we are in a position to calculate ROE. ROE would be the multiplication of all the 3 elements, that is 0.1 to be multiplied by 1.25 and the third component's value is 4. So, the total comes to 0.5 to be multiplied by 100. So, we reach the figure of 50%. So our final ROE using the DuPont model is 50%. Now solving the second problem related to the same model, in which we are having the information provided for two different companies. One is NZ Limited, another is AQ Limited. Again we are provided with the net income, revenue, average assets and the average equity. So going with the question, again using all the three components, the ROE is equal to net profit margin multiplied by asset turnover to be multiplied by equity multiplier. So going with the first is the net profit margin The formula is net income, or we can say profit, whatever is given in the question, net income upon sales or revenue, whichever is available. I'm just writing down all the three formulas, then we compute for both the companies differently. And then we have the assets turnover, which is equal to the sales or the revenue divided by total assets, or I can say the average assets if provided in the question. Then the equity multiplier, which is in this question, can be average assets, as we are given average assets in this question, upon average equity. So moving ahead with the information provided and putting it in the formula, first we calculate the information for NZ Limited. The first step is net profit margin. As you can see from the question, that the net profit margin of NZ Limited is 2 lakh and the revenue is 10 lakh. So we divide the 2 lakh with 10 lakh rupees, we got the figure of 0.2. Next point is to compute, or the next step is asset turnover, in which we take the average assets given in the question in comparison to the revenue provided in the question. So our question will be solved like revenue, which is given 10 lakh rupees, in comparison to the assets which are given average assets 5 lakh. So we got the figure of 2. Then third is equity multiplier, which is going to be using the formula of equity multiplier, average assets 5 lakh to be divided by the equity capital given in the question, or the average equity given in the question, which is 2,50,000 for NZ Limited. So it comes to 2. Now we can compute the ROE for NZ Limited, which will be the multiplication of all the three components we computed, that is net profit margin, asset turnover and the equity multiplier. So we reaches the figure of 0.8. Because ROE is to be computed in percentage, we multiplied this value with 100 and we got that the ROE of NZ Limited is 80%. In the same manner, we compute the ROE using all the three components for the another company, which is AQ Limited. So AQ Limited, for this, first we compute the net profit margin, which is equal to 3 lakhs, net income, revenue 9 lakhs. It comes to 0.33. Next is asset turnover, asset turnover is equal to 9 lakhs divided by 6 lakh, it comes to 1.5, and the third is equity multiplier, which is equal to the average assets divided by the shareholders equity, which is given in the question 3 lakh, so it comes to 2. Computing ROE for AQ Limited, 0.33 to be multiplied by 1.5 into 2, it reaches the figure of 1.0, again multiplied by 100, so we reach the figure of 100%. Now, you can see in the final results that ROE we computed for NZ company was 80% and that of ROE of AQ Limited is 100%. So, we can comment that AQ Limited is having higher ROE by 20%, which shows its operational efficiency related to different activities leads to cost reduction as well as the maximization of profit. One more thing we can add to it is that the fixed assets of AQ Limited has been properly used to increase its sales. So, AQ Limited is performing much better than that of the NZ Limited. Question number 3. From the following information, again we are required to calculate ROE using the DuPont model and we have to comment on the same. Again we are provided with the information of the two companies. One is the M Limited, another is the Q Limited. Gross sales is given, sales return is given, other income, cost of good material consumed and employee benefit expenses given along with the depreciation, taxes, share capital, reserve and surplus, accumulated profit, current liabilities, fixed assets, stock, debtor and cash. So, now we are having a question which is comparatively typical to what we have solved in the first two questions. So, we will calculate information one by one for M Limited, then for the Q Limited and then we compare the same to give the final comment on the performance of the company or on the ROE of a company. So, starting my question for M Limited first. So, I am taking the information for the computation of ROE for M Limited. We start with the question. As you can see with the formula, we need the net income, then we need sales, and in this question we are given gross sales and sales return. So, we first compute the net sales of M Limited. Net sales of M Limited would be 6 lakh, which is the gross sales. Out of that we will deduct 20,000 rupees given as sales return. So, we got the final figure of sales comes to rupees 5,80,000. Next is the computation of net profit. Net profit of the company will be computed like this. What information is provided in the question? We start from that. We are given other income, we are given cost of material consumed, we are provided the other income, employee benefit expenses or the depreciation. Now, we treat the different items to reach the figure of net profit. I am starting with other income, which is given 30,000 rupees plus. You can see out of that 30,000 we go ahead with another amount of net sales we computed just in the first step that will add to our a sort of gross profit. So, we will add that revenue over here 5,80,000. Out of this total we will deduct the different expenses which we have paid, like cost of material consumed 3 lakh rupees, this is given. 15,000 employee benefit expenses, plus depreciation is 1 lakh rupees and taxes is given 9,500. So now I am putting all this together here, 1 lakh for depreciation and 9,500 for taxes paid. So after computation of this, we reach the figure of 1,85,500. So our net profit margin would be, what we just computed is our net profit 1,85,500 to be divided by the net sales that we computed 5,80,000. So we reached the figure of 0.32. After this, moving to the next step is the computation of asset turnover. So for computing this, we need to calculate the total assets of the company. So the total assets would be fixed assets plus stock, the current assets, plus debtors as given in the question, plus cash. We have the fixed assets 1,50,000, stock value 90,000, debtors 75,000 and cash 60,000. So we reaches the figure of rupees 3,75,000. Once we have the figure of total assets, we can compute asset turnover. For asset turnover, we have just computed the revenue or the sales 5,80,000 to be divided by the average assets or the total assets as given in the question. So the total assets we computed is 3,75,000. So we reach the figure of 1.55 as asset turnover. Now the third component is to be calculated as equity multiplier. Equity multiplier, to compute this, we first need to calculate the shareholders' equity, which is share capital given in the question 2 lakh rupees plus reserve and surplus provided in the question 15,000. We have no accumulated profit for this company, so we just add 15,000 to the share capital. So our shareholders' equity will become 2,15,000. So the calculation of equity multiplier is 3,75,000 is the value of the assets we computed in the last step divided by 2,15,000 shareholders equity, we got a figure of 1.74. So after computing all the three components, we can calculate the ROE, which is going to be the multiplication of the three components. One is 0.32 into 1.55 into 1.74. So we will be calculating ROE here, which will become 86.33%. Going to the next company, that is Q Limited. Following the three steps again, First we compute the net sales, which is equal to 6 lakh minus 30,000 return. So we got the figure of 5 lakh 70,000 as the net sales. Then we compute the net profit for the calculation purpose of the net profit margin, which will be our other incomes 50,000 as given in the information provided, plus 5 lakh 70,000 as we just computed as a revenue generated from sales. Out of that we deduct the other things which is provided in the form of the expenses, 3 lakh 50,000, 25,000, 1 lakh 25,000 and 12,000. So we got the figure of 1 lakh 8,000 as our net profit. Now we can calculate net profit margin for this. So net profit margin will be equal to 1 lakh 8,000 divided by 5 lakh 70,000. So it will be 0.1895. Now we calculate the asset turnover. For that we need the total assets, and here in this part of the company Q Limited, net assets would be the fixed assets 2 lakh plus the stock 75,000 plus debtors of 1 lakh plus 20,000 cash. It comes to the figure of 3 lakh 95,000. So asset turnover will be 5 lakh 70,000 net sales divided by 3 lakh 95,000, the total assets. The figure will become 1.44. Now the third component is equity multiplier, which is, we know we have to compute the shareholders equity in it. So we go with that first, the computation of shareholders equity, which is equity share capital given in the question 2,50,000 plus the reserve and surplus 10,000, and one more thing is provided in Q Limited is accumulated profit of rupees 20,000. So the shareholder equity will become 2,80,000 for this company. Now we calculate the equity multiplier. We just computed the total assets of the company 3,95,000 to be divided by 2,80,000. It is 1.41. Now compute the ROE for the Q Limited by multiplying these elements 1, 2 and 3, that is 1.44 into 1.41 into 0.1895. We reaches the figure of 38.46% after multiplying the answer with the 100, which would be 0.3846 to be multiplied by 100, right? Now we can compare and we can see that the M Limited is having higher ROE 86.33 in comparison to the Q Limited, which is showing ROE of just 38.46%, indicating that company M is using its equity more efficiently in order to generate profits. Secondly, we can say that the net profit margin ratio of M Limited is higher in comparison to the Q Limited, showing its higher efficiency, better control and higher profitability. So this is the way how you can conclude this question with the comment. Moving to the next question, question number 4. This is for the prediction of ROE using the DuPont model. So for this question, you are provided with certain additional informations to be included in the question so that you can make the prediction in a proper manner. So starting with the solution, I am going with each and every value, whether it is changing or it is not changing, so that you can make a list of the items and then we can put the items in the formulation for the prediction purposes. Going with the first, now we calculate the different values for ROE prediction. The first is sales. As you can see, the sales are expected to increase by 25%. So we go with the gross sales. You are provided with the information of the gross sales of rupees 6 lakh in the question, and this 6 lakh is to be added by 25%, mean there is an increase by 25%, which leads to the gross sales of 7,50,000. Sales return, because it is a gross, so we have to consider the sales return, which is given in the question is 30,000. So we keep it unchanged, 30,000. So we can calculate the figure of net sales, which is going to be 7,50,000 minus 30,000, 7,20,000. Now next is interest income, 50,000. We are not provided any additional information for this, so it will remain same. But cost of the material consumed is given 3,50,000, which is against 6 lakh of sales. So as the sales has increased, definitely this amount would have to change proportionately. But one additional information is there that the cost of material consumed will decline by 5% due to the economies of scale. So we consider both the things simultaneously. First, we calculate the cost of material consumed, because the sales has increased. So 3,50,000 was the cost of material consumed against the sale of 6 lakh. If the sales is 7,50,000, so proportionately it will reach the figure of 4,37,500. And as the additional information provided that there will be a decrease in the price or there is a fall in a price by 5%, so we consider that. So now the cost of material will become 4,37,500. Out of that we deduct the 5%, which happens to be 21,875, leading to the new cost of the material consumed 4,15,625. Next adjustment show the salaries are expected to increase by 10%, as provided in the question is the salary of 25,000. So our salaries after additional information will become 25,000 plus 10% increase in 25,000 leads to the figure of 27,500. Then depreciation was same, and another adjustment given is the tax liability will increase by 2%, and the tax liability given in the question is 12,000 rupees. So the tax liability which was given 12,000 will be increased by 2% of the same, and it leads to 12,240 rupees. Now going for the next, We are provided with another adjustment that the company is expected to issue equity shares of 2 lakh rupees to finance the additional requirement of plant. So, we will calculate the equity addition also in this question. So, the computation of equity is as provided in the question. The existing equity share capital was 2,50,000, and in the additional information we provided that there is another issue of equity by 2 lakh rupees, but because we have to calculate the shareholders equity, so we will add the amount of retained earnings, which is given 20,000 in the question, and reserve and surplus into it, plus 10,000 for reserve and surplus, 20,000 another amount given in the question as retained earning. So, we reached the figure of 4,80,000 here. In this 4,80,000 we add the new profit, we calculated 1,89,635. So, the total value of equity will become 6,69,635 rupees. Now, the computation will be, first we calculate the profit margin, net profit margin, net profit margin. So, I just use the figure of 1,89,635 which I computed like this. The net profit is calculated as net sales, which we calculated 7,20,000, plus we added the interest income of 50,000. Out of this I deducted the new cost of material consumed 4,15,625, then the depreciation of rupees 1,25,000 and the taxes paid new 12,240. So, we got this figure of 1,89,635 rupees. So, do not get confused, this figure is computed here. Now, the total assets of the company would be, we are having the plant, new plant with the value of 4 lakh rupees, plus building of 1 lakh rupees, plus 75,000 debtors, plus 1 lakh stock and debtors, plus cash, plus goodwill. So, I am adding up all the items provided as an asset. It comes to rupees 7,45,000. Once we computed these two, we will be able to calculate now ROE components. Going one by one, first we calculate net profit margin. As we just calculated the net profit of 189,635 to be divided by the net sales, we computed 7,20,000, it is 0.26. Then we have asset turnover, which is equal to the net sales 7,20,000 divided by the total assets. We just computed 7,45,000 here. So, we got the figure of 0.97. Then we have the equity multiplier, where we compared our total assets of 7,45,000 with the shareholders equity, which we computed 6,69,635, and we got the figure of 1.11. So, now I am going to predict our new ROE after considering all the additional information. It would be 0.26 to be multiplied by 0.97 into 1.21. It comes to the figure of 27.99% after multiplying the answer with 100. So on the basis of this DuPont model, the predicted ROE of the Q Limited is going to be 27.99%. It is less due to the fact that the additional investment, even though it is made in the plant, fails to generate the additional revenue in proportion to the amount that took place as a change in the plant value. That's all from my side. I hope now you will be able to calculate the ROE using the DuPont model, and you can be there to calculate the prediction of the same to make the decisions. Thank you so much for your attention. Thank you so much.